Good evening, all the joinees. Thank you for joining in. This is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. Meanwhile, others join. Let me introduce the topic that we are going to cover today. Today, we will be covering the NGEN Markets newest upgrade, which is called NGEN Markets Pro. We will be covering the three modules that are covered in the NGEN Markets Pro version, starting with portfolio strategy templates. Second, the client risk profiler, which is used to come up with a score of 2 to 10 based upon a set of 5 questions. And the third, financial planning tool. This is a goal based financial planning tool that you can use to generate projections of possible future outcomes of your investment today. Right. Finally, the forum will be open for a Q&A session. You can either type in your questions in the chat box or directly unmute yourself to speak. Let us now begin. In order to access these three features on NGEN Markets, you first need to navigate to the Pro version. That is the fourth tab on NGEN Markets. The moment you click on the left-hand side panel, this is the fourth tab, which is called NGEN Markets Pro. The moment you hit on it, the first module in the Pro version will open up, which is called Strategy Templates. Now, please note, these are a collection of various interesting and strategically designed 100% automated portfolios. Now, these are created using an algorithm and should not be construed as recommendations that NGEN Markets is giving, right? Um, Now, let me speak about the logic that we have used to come up with these strategies. So, the fixed parameter that we have kept is the categories to be included in each of the subcategories. So, for example, if you are focusing on asset allocation, then the three or the four strategies that we've really released is one is it is a collection of a portfolio which has equity mutual funds targeting on minimizing the portfolio volatility by category diversification, right? So we've fixed the categories, and the choosing of mutual funds from that categories is 100% automated, right? There's no cherry picking that is involved. Therefore, no qualitative inputs are involved from our side to pick funds from these set categories. In order to view a particular portfolio strategy template, you can simply click on this run full analytics of this strategy icon. When you do that, a detailed portfolio analytics on this particular strategy will run up. Here you will see that this portfolio consists of these 5 mutual fund categories, right? We've considered focused funds, large cap funds, mid cap, small cap, and value. Now, once these categories are set, the fund picking as to which funds should be included in this portfolio so that this becomes an aggressive growth portfolio is done basis a code which will typically pick up those funds which score higher on the basis of NGEN FS from each of the categories. Now, as you would be aware, NGEN FS is always used to compare funds from within the category. So, for example, in this case, let's say small cap as a category. What it will do is it will pick top funds from each of the categories. So now this NGEN fund score sorts these funds basis their highest risk adjusted returns, right? So returns and volatility. And of course, some portion is also allocable to their AUMs. The qualitative parameter under consideration is age. So as of now, we are using NGEN fund score to typically simulate the picking up of funds from each of these categories. Now, if you see here in the stats tab, you see these are the 5 categories that have been chosen. Now, let's see how this allocation comes up. To come up with an optimal allocation for each of the components in the portfolio, we have used our in-house optimization tool, which is called Improve, and assigned weights to the components of the portfolio basis sharp value as a model, right? If you kind of try to run a optimization feature here and give weights, um, it will give higher weight to that particular fund, which has the best Sharpe ratio in this lot. It will consider these 9 funds. The highest in this case happens to be Tata Small Cap Fund. And therefore, the highest weightage has been given to Tata Small Cap. That's a weightage of 14.5%. Now, please understand the purpose of generating or rather publishing these strategy templates is not recommending that okay, this is what you should go with, and this is what every MFD, whoever is our user, should kind of give to their clients. Instead, these could be used as a good reference point to play around with the schemes, or for that matter even categories. Right now, how will you kind of tailor make these portfolios to suit your requirements, one, or your client's requirements, two? We'll understand that. So for that, we will again go back to strategies. And in these, each of these strategies, we've given, in addition to this play and quick view button, the other two buttons, which practically take this entire template and copy this portfolio to the portfolio section, right? The moment I click on this, it will save this portfolio under from strategies tab in the portfolio section of your NGEN Markets module, right? So you click OK, you go to the portfolio section. Because this is from the strategy templates, this is where it will appear. And then you can just simply hit on edit. This is how you can edit the weights, one, as per your requirement. Two, if you think that, okay, I kind of am okay with other funds in this category. However, instead of a Tata small cap, I do not want this particular fund. I instead want a Bandhan small cap to be included in this portfolio. What you can then do is, by simply clicking on this cross icon, it will remove Tata small cap. The allocation is, in this case, 14.50. You click on this, this will get removed, and replace this with a Bandhan small cap, for example. We search for this fund by clicking on add fund and locate this fund right here. This gets added and put in a allocation of 14.50. Right. This is one thing that you can do. Then, of course, you either click on update and then run, and then, of course, take PDF, PPT reports of these portfolios to send across to clients. This is one thing. Here, what we've done is we've kept the number of funds, the count of funds intact. But let's say there's another case wherein you're not okay with, let's say, two focused funds, right? In this case, as you can see, there are two funds from focused as a category. One being HDFC Focus 30, and the other is ICICI Pru Focused Equity Fund. Let's say you want to keep either of them, and you decide to go with HDFC Focused and remove iPru Focused Equity. You simply remove this entire position of 9.74% from this portfolio by clicking on this cross icon. And now you cannot simply save this portfolio, because this is a 90% allocated portfolio. It has to be a 100% allocated portfolio. For that, you can simply click on rescale to 100, and internally the weights will be assigned to each of these 8 funds now in the portfolio, so that the portfolio adds up to a 100% weight. Once this is done, of course, then you can simply say update my portfolio, and you can then go forward with the PDF and the PPT downloads and a portfolio analytics on this particular portfolio, right? This is one thing that you could do. The second thing that is possible with these portfolio strategy templates is you can create white lists of funds. Let's say you do not want to include these funds as a portfolio, as a ready-made portfolio, and to circulate it to your clients. What you can instead do is You can simply click on this compare icon, and all of the funds from a particular portfolio strategy will get added in one single go in the compare section, right? As you can see, it's right here. You can save this as a watch list for the month of December and keep on monitoring for each of these funds return statistics, or for that matter, volatility statistics going forward, right? So for doing that, you simply say, okay, so this is my watch list December 2024, and then hit save. When you do that, this list will get saved. To access it the next time, when you do not have anything in the compare section, you simply need to go on my list, sort it on the basis of date created. So I created this on 6th of December 2024, that's today. I click on this and the entire list is retrieved, right? In addition to this, if you simply want to generate a equally allocated portfolio, do not want to optimize it basis any weights per se, right? No sharp optimization, no minimum volatility optimization, just to get a overall sense of it, that what happens if a equally allocated portfolio is created basis these funds that you've currently copied from any of the strategies. What you can then do is you can simply click on convert to portfolio. In one single go, equally allocated portfolio will be created of these components that are there in your main list. Again, that can be accessed in the portfolio section. Here, in this case, it will be in compare folder. You click on the drop down and run analytics on this. This is, of course, a equally allocated portfolio, just to get a sense of it, right? If I do not, specifically allocate it on any basis, but just a general equal allocation, how does the performance look like? Right. And in this case, it's even in spite of being an equally allocated portfolio, it is still an outperformance. Right now, in this case, if you will see, the collection right now is a set of 15 strategies. We are open to adding more basis the reaction or rather the feedback that we receive from our users. And these strategies will update on a monthly basis. Now, by update, I mean that the weights that are given in these portfolio templates. So, for example, in this case, Parag Parekh has gotten a weight of 17.40. This is basis its NGEN FS, that is NGEN Fund Score, as on 30th of November 2024. And the last rebalance date will be visible here. Now, if you check this somewhere in the month of January, you will see these weights update, because we will then consider the December rebalance date and update the funds as well as the weights on the basis of December end fund scores. Right? Therefore, the strategies are not going to be dated ones, they will keep on getting updated. That's about strategy templates. Now, let's move on to the next module of the Pro version, which is called Risk Profiler. The moment you hit on this, you will see a questionnaire of 5 questions, right? The responses to which will generate a score between 2 and 10. Now, there are couple of ways, or rather more than a couple of ways, in which you can fill out this questionnaire. First is, let's say the client is sitting in front of you in your office and you want to do it for the client yourself inside of your NGEN Markets login. To do that, you simply go on NGEN Markets login, you log into your platform, you go to the Pro version, and in the Risk Profiler tab, this is where you will click on Start. The moment you click on Start, basic details will be asked. The name of the client, the PAN number, email ID, and the phone number. And the moment you hit next, one by one, a list of 5 questions will open up, right? This is the first way of doing this. The second way is, we have given you an option to let your client himself or herself fill out the questionnaire by sharing it across as a link via WhatsApp, right? So for that, you simply click on this WhatsApp icon. When you do that, a small dialog box opens up. which will ask you to put in a 10-digit Indian mobile number of your client. You put in that here and click on send WhatsApp message. When you do that, a SMS or rather a WhatsApp message will be sent to your client's phone, which will prompt him to fill out that 5-question questionnaire. Right? That's the second way. The third way is by clicking or otherwise by generating a shareable link, which could be used by you to share it across to all of your clients via email, which, if you think is a more formal way of sending this risk profiler, you can, of course, go forward with that as well. To do that, you simply click on this copy icon, and a permanent risk assessment URL will be generated for your login. When you do that, you simply go and send it across to the client on email. So, for example, you've sent that email across, and the client has clicked on that link, right? It will look, if he clicks on it on a desktop version, it will look something like this. Because this is, optimized for a mobile view, I can here itself show a mobile view for you. Just one second. Right. So this is how the client will be able to see it on his mobile device. Right. Once you've put in some basic details, of course, name, PAN number, email, and phone, you click on next. The first question in this risk profiler will be about the age bracket. Right. So in this case, let's say that is 31 to 45, for example, and then I go next. The second question will be on disposable investable income, right? So, how much is your level of income? There are 4 options, of course. So, lots of spare income. I have either regular, mostly fixed excess income, small amounts of excess income that is available for investing, or very little spare income. So, let's say client chooses I have a regular but mostly fixed excess. The third question will be on the basis of investment time horizon. That is the time period that the investor is ready to keep his investments for. So let's say that is between 3 and 5 years time period. So that's the second option. And then you hit next. The fourth question will be on client's expected behavior to a loss in his investment value. So, for example, if there's a 20% loss in the investments that he currently holds, how will he react to that situation? So, of course, again, four options. If he says that, okay, I will hold but refrain from adding more, then that will be the option number 2. And then you move forward with the last question, which is on investment knowledge. The client, let's say, says I have a basic understanding of finance but don't feel confident in making decisions, and therefore is kind of coming to you, right? And then he says finish. When he completes this risk assessment, this risk score will not just be visible to the client on his device, but also get updated in your login in the risk profiler section. The benefit of this is you can generate a neat and clean PDF report of this risk assessment of your client and share it across with him, which then can act as a guideline to direct the investments that you will make for the client. Right? This could be called as a basic version of an IPS, investment policy statement. Right? To access that now, um, you simply again go back to your NGEN Markets platform and then hit refresh. Currently, you'll see there is no example 100 right here, right? So the moment I hit on refresh, this will get added. You can, of course, sort it again on the basis of um, the date submitted. And you see example 100 right here. You click on this download risk assessment report and a PDF gets downloaded. Again, this is a export that you're doing from NGEN Markets. Therefore, this will also have your organization's branding. Then the scale, of course, between 2 and 10, 2 being, if the score is closer to 2, that typically means the investor or your client is risk averse. On the other hand, if the score is lopsided to 10, that practically means he is a risk seeking investor. He has a aggressive attitude towards taking more risks, and he's fine with it. Right. Next is, of course, the responses to his questions. In terms of course, graphical manner, as well as the options that he has chosen. The last page, of course, will be a disclaimer which can be edited as per your requirement. So this is how the output of this risk score will look like. Now, just one thing that I wanted to highlight is not just that these PDFs are co-branded, but this link will also be co-branded, right? So when you see this link right here, currently, of course, it has NGEN Markets and NGEN Research. That's because it's my login. However, if you've integrated your organization's logo and name, if you check it in your login, it will be your organization's name and logo here, right? So the link is also with your organization's branding. Now, before we move forward to the next module, I would just like to address one thing here, that we've purposely kept this questionnaire to be concise and with a list of 5 questions only, in order to ensure that there is minimal reluctance from clients in completing the risk assessment. I mean, we definitely did come across with questionnaires which had, you know, questions running in multiple pages. But the entire purpose of generating this risk profiler is to ensure that the clients complete this in the first place, and then the starting point or the journey of investment begins. So if it's made a very long questionnaire, the clients, generally get bored and then they do not end up completing that. Therefore, we have purposely kept it and rather restricted it to 5 questions. However, if we are definitely open to feedback. And going forward, we could definitely think about adding more questions so that this becomes a more robust IPS. Additionally, currently, this just generates a score between 2 and 10, and of course, a PDF report. But going forward, we also plan to introduce some model 100% automated portfolios basis the risk score that is generated that will be visible on the risk profiler tool itself, right? So, for example, in this case, the risk score is 6.67. Now, a automated portfolio will show up here that, okay, if this is a 6.67 risk score, this could be used as a start point to construct portfolio, right? So, of course, set of categories again will be fixed. No cherry picking involved in choosing funds. There'll be no qualitative input from our side. It will be a algo based 100% automated portfolio that will be generated. Again, option to edit, option to change will definitely be there with our users, right? But a start point will definitely be given by engine mark. Of course, that is a thing to be discussed later. We are contemplating on introducing this in the future. This is the second tab. Now, let's move forward to the third and the final tab on Engine Markets Pro, which is called Financial Planning Module. Now, this module is meant to do a goal-based financial prediction of a amount that you input. So until now, if you would see on engine markets or during demos trainings, we always said that engine markets will do analysis on the basis of historical data, because historical data is the best bet that we can have. However, we received a lot of feedback saying if you could add in some futuristic modeling to this, it could be a good point for us to, use when we are sitting in front of the client, and also it'll make the platform more holistic. And that's why, with the basis of established mathematical models, we have come up with this goal-based financial planning module. Here, the financial models, or rather the mathematical models that we are using, are 3: Monte Carlo simulation, binomial tree model, and geometric Brownian motion. Now, the benefit of each of these 3 models is that each of these 3 have a required flavor of randomness to them. However, this is within the boundaries that you can input, right? Meaning each of these will ensure that the prediction or the future possibilities or projections that we are trying to generate are adhering to the randomness that future in itself has. However, that randomness will be ensured that it is in the parameters that you input here, typically for returns and vol, right? Now let's start from the basics. Let's say you're sitting in front of the client, and the client says that, okay, I wish to buy a car 3 years down the line. The price of the car is, let's say, 25 lakh rupees. Then you put in the goal right here, right? So target amount, you check this box and you input that 25 lakh rupees here. Then the next question that you ask to the client is, okay, when do you wish to buy this car? I mean, how long until you would like to buy this car? So he says, okay, I plan to do that in the next 3 years. So then you input 3 here and you click outside. It will pick up a target date that is 6th of December 2027. Now, the next question and the important question that you'll ask him is, what is the amount that you are, ready to invest right now in order to achieve this goal? To which, let's say he says that, okay, I currently have a corpus of 5 lakh rupees, and that is what I would like to start with. So you put in the initial lump sum of 5 lakh right here. Then your next question will be how much monthly SIPs that you could do in order to save for this and of course invest for this particular goal. So then he says that, okay, fine, what would you recommend? So then let's say you say 10% of initial lump sum could be decent to start with. And then that of course comes to 50,000 rupees monthly step up. So then you put 50,000 right here, and then the parameters for expected assumed return and a volatility number comes up, right? Those will be put in right here. Let's say an assumed expected return of 15% is what you put. Of course, as you can see, everything is editable, so you can of course simulate a higher return or a lower return as required. And on the other hand, we've also given a parameter to input vol. The benefit of this is when we now hit on rerun, this will give you projections on the basis of risk adjusted return of zero point 0.6. Now, how have I arrived at that? So that's return by vol, right? So 15 divided by 25, right? So that's per unit of risk that you take. What is the return that you're getting? So that's 0 0.6, 15 divided by 25. This is what I meant by boundary, or rather setting boundaries of the financial or the mathematical models that I'll be using now. I will be using Monte Carlo simulation, which ensures generation of random numbers. But that generation of random numbers and these projections, resultant projections, will be in the gambit of zero point 0.6 risk adjusted return, right? Now I will hit on rerun. And this tells me that with these parameters that you've input, there's a 91% chance, or with a 91% probability, I can say that these projections meet your target amount. That means there could be one-off scenarios wherein your target might not be met with the current step ups that you're doing, with the current initial lump sum that you've put, and the time horizon, and of course, your return and vol, right? However, in all the other scenarios, as you can see, 91, right? So the balance 9% is typically 22 lakhs 86, which is less than your target of 25. Therefore, this is color coded into red. That means your target is not achieved. However, the other projections just ensure that your goal could be achievable, right? Now, just to add perspective, we've also given you a linear growth based model. All the other projections, projection 3, 10, 7, 5, you can see these will be generated basis the Monte Carlo simulation, or for that matter, any other mathematical tool that you will choose from here, right? However, there will be one among these which will be called as linear growth model, which typically negates any different randomness of each of these projections. That means if your investments grow at same pace, of course, with the step ups, this is how you will get, which practically with will exactly match with this risk adjusted return. Now, of course, though this is desirable, this will not be achievable in real life because, of course, in fact, will be achievable in real life only if you invest this in maybe a risk-free instrument, maybe a risk-free bond, or for that matter, FD, assuming, of course, the bank does not go bankrupt, right? In all the other scenarios, it is going to try and simulate the market movement and accordingly project this as a scenario. Now, to understand this in a little better manner, I will show you how each of these projections are derived at using this Excel download that we have, enabled. So when you open this Excel sheet, it will look something like this, right? Of course, all the other models will also be visible, right? So each and every day from the start date that you've input, so we are standing on 6th, right? So it is trying to simulate a number every single day, every single working day, right? Now, if you try and check the daily returns and rather try and calculate the daily returns of each of these scenarios, you simply need to apply a simple Excel formula that, okay, so divide return of 10th of December divided by the price on 9th of December and then minus 1 so that it is converted into percentage. And that's a daily return of 0.04 for the first day. Now, this will continue getting generated every single day until a next installment. That is, the next step up happens. The next step up happens on 1st of Jan, which is why you'll see there's a significant spike in the daily returns. Now, this is not because the markets have increased. This is because additional sum is being incorporated, right? In the corpus, and that is right here. That's 50,000 getting added to your investment. Therefore, there's a huge jump of 9.95. Now, in order to just justify that these are within the parameters that we have input, you will see if you take a CAGR, or for that matter, in this case, simple return, annual simple return of each of these numbers, that comes to a return of a 61%, right? That's zero point 0.6 risk adjusted return, which is what we had just derived. I'm showing you all of this just to validate that each of these models, that the results of which you're seeing right now have a certain mathematics that is going at the background, and this is what is the mathematics. Right. Now, of course, if you will see here, there are some projections that are not meeting the target, right? So, for example, projection number 6, it is not meeting the target of 25 lakhs, and the risk adjusted ratio here will typically be less than zero point 0.6, right? And it will be somewhere around 0.55, right? So these results or the projections that you can see are replicable when you do that into an Excel sheet, right? Of course, but the calculations will go on and on. Right? Now, again, if you notice here, we have mentioned clearly that every time you hit rerun, different future values or different projections will show up. And that is exactly why we call these models random. That means no single time will you be able to replicate the same projection. Simple example, without changing these parameters, I'm simply going to hit on rerun again, right? You see the probability has changed. Did I change any parameters? No. Why has the probability changed then? That's because this is just validating the randomness of these models. That means these models of kind of simulating the future are working. And these are sometimes, or rather, these are showing times. There could be some times when the goal has been achieved, and there could be some others when the goal is not achieved, right? Therefore, the probability of these projections meeting the target in this case is 73%. right? Now, once the logic of this financial planning tool is clear, we then have also enabled a PDF report download of this, which can again be created by clicking on this PDF download icon. When you do that, your organization's branding will also be available on this PDF report. It will have the basic parameters that you've input: initial lump sum, monthly installment, return assumption, volatility assumption. The first projection will be the linear growth projection, and just following that will be all the other projections, 1, 2, 3, 4, up to 10. Of course, here you can generate at max 10 different projections at one point of time. You can, of course, decide to reduce those possibilities by, reducing it right here. So let's say you want to generate or rather view only 5 different outcomes. You can reduce it to 5 and then hit rerun. And 5 different possibilities will be created. One among that will, of course, be fixed, that is linear growth model. However, we recommend, using higher projections so that you're closer, or rather you have multiple, projections here, which typically are trying to simulate what could be the future outcome, right? So we would recommend you use 10, and then of course hit. All right, so that's about it from my side for the topic related webinar discussion. Now the forum is open for a Q&A session. Thank you very much for a patient listening.
There are a couple of questions in the chat, I think. One is about changing the funds allocations, or even adding funds and replacing funds in for the strategy section. So Prajakta, let's just go to the strategy section once. So we've, we obviously, we expect users to kind of edit these models as per their requirements. So the easiest way is to just copy them to the portfolio section, just one click. And when you do that, in the portfolio section, now you're free to kind of do whatever you want. That it is saved now. And it'll be an automatic folder creation for you from strategies, and you can just edit and then change whatever you want. So you should be able to do this pretty easily. There's another question which is asking about the what's the conclusion of the 91 and 73%. So I believe that's the projection model. So let's just go back there for a second. So this number that's 82 right now, this is basically saying we use these models, use these inputs to project the future out 10 times, right? And if you scroll down here, just scroll down a little bit to the bottom chart, you can see 2 out of the 10, and there's one linear that's always going to be there. But 2 out of the 10 didn't make it, right? 2 out of the, well, including the linear, so 2 out of 11. So it's basically telling you kind of what percentage of those forecasts didn't make it, or did, in fact, in this case. So 82% of your forecasts will actually reach that goal. Now, as mentioned before, if you rerun this, that number will change. It will change, of course, because it's again trying to project the future. And as you keep projecting it, that number will change slightly. It will not go from 80 to 20, of course, but depending on your inputs, it'll hover around a certain kind of number. I mean, technically, with these kind of algorithms, if you really want to push things further, what we do is we literally rerun 10,000 times and then take the average. And that is kind of considered a bit more of an accurate, kind of accurate expectation of whether or not we'll meet our targets. But in this case, obviously, for, this is a browser, so we can't really run that many in one go. But as you can see, every time you run, the number changes. And it changes because we're, again, recreating another future using mathematical models. And obviously, every time we recreate the future, the possibility of success will change on every single run.
Can we say that when we talk to customers, that there are out of 10, 7 times there are chances that we will hit the target?
That's right. That's right. That's right. And again, because we are projecting, obviously no one knows the future, but these are kind of, I mean, these models that we've used, they are, these three models in particular are widely used in finance, basically to predict, behavior of financial variables. It's used in everything from, options pricing to stocks to basically every financial instrument. And these three different models have slightly different ways in which it predicts the future, but it's all based on kind of generating random numbers, but within a given set of parameters. So Monte Carlo is something actually that is used in gaming and casinos, in fact. Hence the name. The geometric Brownian motion is more of a kind of continuous model. Where it's understood that stock prices will be random, but it also assumes that there is some kind of expected growth over time. And that expected growth is that number that you as a user will put on the top, the assumed return 15%. And the geometric Brown motion model will try to simulate a realistic price movement of your money over time to reach that goal. And sometimes you'll reach around about that. You can see all the lines are upward sloping, right? So you can see that there is an inbuilt trend in there, and that trend is defined by that 15%. Just to give an example, if you keep the 15-15 and change the assumed vol to 5, you'll see much smoother lines, because now you've said, change it to 5. No, not the number of scenarios. Go back to 10. So at 15, so now you go 5. You can see how much smoother the lines have gone, because you're literally telling the model that I'm going to make 15%, but with a very low vol. Whereas if I increase the vol to 25, I'll get there, but there will be some up and down along the way. So just increase the vol again to 25. So you're expecting more risk to happen. And then the model will take that into account. And as soon as you do that, some of your projections won't get there. When you use standard kind of linear models, which is the one that we're always showing you there, this is what you'll get if you use a typical online calculator, right? Where, I put 10 lakhs, I put 50,000 SIP, where do I reach, right? That's a kind of a straightforward calculation. So that's always there as a base case. So if you did that straightforward calculation, you'd always get 100%. Yeah, if I make 15% over the next 10 years or whatever, 3 years, I'll get there. But we all know if you've got any equities in your portfolio, it's impossible to get a fixed return over a number of years. You don't know what's going to happen. So you have to kind of take into account the fact that markets will be uncertain, and this does that to some extent. And for your client, it will kind of nice to see that I might get unlucky and not make it.
Can we say that linear returns does not consider volatility? It is just a compounding interest answer.
The linear absolutely does not consider volatility. That's right.
It will be
is
compounding answer.
Yeah, compounding
ESGR
it
answer.
considers. Yeah, because linear growth is literally, it's just saying today is another day. I'm going to make 15% divided by 365 today. If it's Monday, I'm going to make 15% divided by 365 times 3 because of the weekend. That's it, right?
Correct.
As if if you got 15% every today, that's what you'll get, right? So when you have equities in your portfolio, it's almost kind of useless to do something like that, because you're literally saying, I'm going to get 15% CAGR over the next 3 years. You might, I'm not saying you won't, but firstly, the path will not be like that.
No, never straight.
Never straight. And it would not matter in a lump sum case where you put money today and forget about it for 3 years and you get 15% CAGR later, fine, right? But you're adding money every month. That money may be getting added at peaks or troughs. You don't know, right?
Right.
It's going to affect your results over time. So this is showing you the effect of all that.
So one adding that to that is this way, we have historical returns of market that it is say somewhere around 16% in last 40 years since 1979. But do we have any figure where we can have that, on an average, this kind of volatility is there in 10 years, 5 years, or since the markets have started, so that we can put an assumption over here?
Absolutely. Actually, that's a great idea. In fact, we did a little bit of that when we put that button. So your projector is checking, and you checked it. So we've got the use market vol. If you click on that, this is literally taking Nifty vol and inputting whatever Nifty vol is today, right? It's put, I think, last 3 years. Yeah. Last 3 years, Nifty vol is putting. Maybe we should put some automatic buttons right next to the return saying use the Nifty return as well, right? So you can use the assumptions directly from the market. So CAGR is what 3 years karke dekho. Where's the CAGR? 18.77%. So we basically put that number. Yeah, so put that number in the projection model in the return, right? So that's what Nifty is doing, approximately following the parameters of what Nifty is doing. This is the kind of result. It looks pretty good, right? So again, you can change these parameters depending on the picture you want to talk about. You want to talk about a risky picture, you increase the vol, and show them that if things go things go a bit awry, what's going to happen then. Yeah, so that's the point of this section. Of course, we're going to keep adding more things. We've already got a very good suggestion a few days ago from someone who upgraded, was this 91% is coming because you're putting some inputs, and one of the main inputs you're putting is 25 lakhs on the top. That's the money I want in 3 years. What's my chance of getting it? 91%. But they said, what if I say I want 25 lakhs, but I want 75% probability of getting there. In order to get there, how much monthly addition should I need to do if I'm happy with the 75% chance of success, right? So it kind of back calculates, and you can tell the client that, okay, it's not 100%, but you can put a little bit less, you still have a decent chance of getting there.
Correct.
So yeah, so we'll obviously, as you know, we'll keep improving.
No, as if you said that market volatility is for last 3 years, can we from where to derive 5 years or inception that volatility?
Oh, very easy, sir. Very easy, sir. Just as what Radhika just did right now, is just go to the compare section. Add an index, whichever one you want to add, 50, 500, whichever one you want to add. And then you literally just change the start date. So let's just add one more. Yeah. So let's say these are two indices you're adding. So the start date Prajakta's put right now is 3 years ago. So you just change that to 24, we are 2019. That was a 5-year, right? So whatever date you want, you put it there, and then the standard deviation, this column, you see the vol and you see the CAGR. But we'll add some easy buttons to use, a couple of indices, and it'll automatically add it. So it saves time.
Yes, thank you. Can I extend one more question?
Please, sir, please.
These 10 projections which gives different answers, right? If I have to explain it to my client, what is the difference between, say, projection 9 and projection 10?
Okay, the difference is, I can use some science fiction analogies here, but this is like saying we have some defined parameters for the future, right? Now, within that, we've used mathematics and random number generation to come up with a possible future. If I keep doing this, I will keep getting different answers. So projection 1 and projection 9 are randomly generated within the parameters of what we want. And the thing with these models is, obviously, they've been tested so many times throughout the last few decades that, generally speaking, they fit in quite well with, if you look at this chart, you could easily mistake this for a mutual fund NAV. The thing is, these are randomly generated. There's really no difference between projection 9 and projection 1. These are like, parallel realities. That's exactly what this is. And what you're doing is you're projecting various different realities that could take place over the next 3 years. So projector, just click it one more time, right? And you'll see 9 will change, so will 1. No matter how many times you click it, it will keep you giving you different answers. As you can see, as we're clicking it, it's changing over and over and over again. So with kind of deeper research models, as I said earlier, this clicking of this button happens tens of thousands of times. And then they take all these results and then they take the average, which hopefully gives you a better understanding of where I could reach. We could probably build something like that, but again, as you can see, it will take time to actually run that many, even for one simple request. But even what we've showed here should definitely give you a good idea, because you can see in every case, you are getting enough which are above and enough which are below linear. So you're kind of, for a client, this should be useful because linear is nice to see, but we know it's not going to happen if you have equities in a portfolio. It's impossible. That's not going to happen. Something different will happen, but that's not going to happen. And the ones above that and ones below that, they are showing you, kind of possible results. So there is no real reason to kind of look at 1 versus 9, other than the fact that one is better than the other, and you should be prepared that you could land in any one of these realities.
91% is opposite of VAR.
So I couldn't hear you, sir. If you could repeat.
Opposite of VAR, VAR.
Well, not really, sir. I mean, VAR is value at risk is basically deriving all its probability from the actual returns of your fund or your portfolio. And so the VAR number you get is completely calculated using whatever your portfolio has done or your fund has done. This is different because you can see the only numbers that you're inputting into this, if you scroll up, there's no fund here, there's no portfolio here, there's nothing. Right?
Correct.
This is saying that's the kind of return I want. This is the kind of vol I want. The money stuff is, whatever you put doesn't, it's not going to affect how the forecast is done. The only thing that will affect how the forecast is done is the return and the vol, and obviously the time period. Because, for example, the binomial tree model, it actually works backwards. So it goes to the end and moves back. And it knows there's only 2 paths, up or down. But what's the probability of up? That's derived from the return and the vol. What's the probability of down? Then it says what is the probability of what chance do I have of getting X% return? Again, those are derived from whatever you put for return of vol. So this is quite different from the concept of VAR, because the concept of VAR is basically is based on what you've achieved in your particular returns for your particular asset. So this will be quite different.
It will be historical. VAR is historical.
Yes, exactly. That's actually the main difference.
Okay, thank you.
Hello.
Yeah, hi.
Yeah, hi, Anna.
Yeah.
I have a question that in risk profiling, there are
Yeah.
2 parts. One is the willingness to take risk, and other is the ability to take risk. So, as per what I can see here, what we can get is the client's willingness to take risk.
That's right.
Can we incorporate the feature like ability, whether he should take this much amount of risk or not, or whether he
Of
can
course.
increase his risk appetite?
Of course. So we have one question here, Prajakta, if you just quickly just try to, print the report. Actually, we can see from there. Yeah, so one of them, I mean, we're very happy to take suggestions from you. So other than tolerance to losses, the second one is kind of asking about how much money you really have. But like, what are the things, because you guys will know much more than much more than us about this. Like, what kind of questions would you ask a client to determine their ability?
Yeah, in my view, what we should ask is like that how much of their savings portion, okay,
Yeah.
the liquid funds are investing in the mutual funds. In this way, we can get the idea whether he should be taking more risk or not.
Okay. So, so here, for example, if you look at question number 2, disposable income, maybe we can make this either more specific, or we can add a further question to this questionnaire, which talks about what percentage of your savings do you have available for investments in mutual funds / stocks or something, right?
Investable income or something.
Investable income. Yeah, I think that's a great suggestion. And obviously the answers have to be about, some kind of choice. So, it'll probably be something like, 10, 30, 50, 80, something like that. What percentage of your savings would you invest? Right. Fair enough. We can work on adding this or editing this particular second question to kind of incorporate that.
And Bob, you can add one more thing into this.
Yeah.
That you can put some toggle buttons over there where after disposal will come towards which side, that one pure equity, hybrid, or debt. So that customer can choose that, okay, fine, I have a disposable income of such amount. Want to put 70% into equity, 20% into hybrid, or 10% into debt.
Fair enough. So you'd want to record that information, or do you want that information to be used in determining the score?
I think that will help in determining the score also, no? Because it shows that client is risk averse or not, and he himself is committing onto that.
Got it. So if they say I can put 60% or something like that, but only to debt.
Tolerance to losses or investment horizon just above that.
Right.
You can put something. Somebody can put a range. Okay, fine. Equity, don't know should be there. Yeah, as per the standard, which will take it automatically. But one thing is that where he can put a range over there. Okay, 70% okay, equity is fine. 30% maybe debt, or maybe 50% equity, 20% hybrid, and 30% debt.
Yes, fine, fair enough. Yeah, we can work on perfect. We can work on.
If client is not aware about equity, and then he can just skip that question. That should not be there.
Fine, fair enough. We'll look into this one.
Second question to me is this, that while designing these portfolios, there I have seen that there are certain schemes like if you open that aggressive kind of thing, which was the first one, aggressive growth. There are couple of funds from the same segment, like won't be overlapping onto this, like Discovery and Focus, HDFC Focus and ICC Focus. There will be overlapping, and the portfolio will remain as it is.
Yeah, see that is true. There will be overlapping in this case because we don't have currently in the strategies algorithm. There is no filter that checks for overlapping funds. So this might be a good idea that we can add a further filter that if we find such overlaps at the time of picking the
another suggestion to that, you can define a limit for a particular segment, like if it is focus, maximum 2 funds can be chosen from there.
Yeah, so the only issue that happens, the problem is that the more constraints we put,
it will not give you an accurate picture over there.
Yeah, and then what happens is we are literally designing the strategy with our filters, right? So for example, if we say, okay, 30% should not be more than large cap, it will you will never get any benefit of market cap optimization, because maybe it does over time, over 2-3 months, move a little bit extra into small cap because small cap Sharpe ratios are doing well. And but the overlap point is correct, sir. That we that I think
either it should be at your end, or else we can do tweaking over there, because
of course,
if there will be overlapping, hardly will be 1 or 2 funds will be there.
Exactly.
If they are showing overlapping, and that to be for a very narrow category.
Exactly. So here, as Prajakta just done, very quickly you can see, okay, and because you will know the AMC you like better, which fund is better, then you can see, okay, what is this Nippon and blue chip, which let's just see, Nippon India ICICI value. So you will know which one to pick, right? And you can easily just go to the main list, delete one,
and can replace it with any other category of fund.
Exactly, and replace it with something else, copy to portfolio. And so in fact, sir, that is really the kind of approach we've used for this. The strategies tab is to give you a template which you can then edit and change as per your requirements. But of course, if there are issues that come in portfolios, we'll try and work on them.
See, if we make changes into this, but your system will run the portfolio you have shorter listed.
Yeah,
it will give you, and then every time we have to do some tweaking into this, that same fund has to be replaced by another one, and then we should rerun it.
So do you mean over
See,
time?
because if I make some changes, it will not be saved into my
Oh,
system.
no. It will be saved. It will be saved.
It will be saved. Okay.
Yeah.
Then I can.
We can show you very quickly. You go to
Yeah,
the pro
please.
section. Let's say you take the aggressive one, you like it, but you want to change it. So you
Okay.
place this middle button, right? Save this to portfolio section. It will save it on the portfolios section here.
Strategies under strategies.
From strategies. Here, I think Projecta already had one. That's why I added a dash X in front of it, right?
Right.
So now you go and edit it, right?
Okay.
You make some changes. Let's say you take one, whichever I think is
I
valid.
just want to remove, say, focus 30.
Focus 30, remove. Okay, and add one something else.
Any multi-cap strategy which we can put into this.
Yeah, so just search multi-cap and just pick anything. Yeah, fine. Okay. So now you can rescale to 100, right? Just to make sure. And then you run it. Okay, fine. So you can, for example, you can just update this, right? Or if
Simply
you
by
want,
updating, it will be 100% then.
yes, you saved it, and now it's saved for you. You can rename it as something else if you want to keep a copy or whatever. But it's just like
Okay.
a document. Now it's saved for you. So now because the portfolio section is outside the pro section. This is your work
Right.
area. You can keep whatever you want here. You can rename it just like, this is my whatever, my model portfolio, whatever, my aggressive portfolio.
Right.
Right. So here is it. So that's it. So your this is saved now, right? And you can keep this saved. You can keep updating it. So that's like a start point for you. You can take it, edit it, save it, and that's your model portfolio now.
Okay.
So you can make as many copies of that as you want and edit them.
No, definitely you have done a phenomenal job over there. Honestly saying, was waiting since long.
Thank you, sir. We will keep working. We just want more feedback from you guys, and we'll keep improving.
No, I'll take in the individual section. I have a couple of queries which I'll discuss later on to
No problem, sir.
one to one. And apart from that, there's 2 points which we have discussed in earlier call also.
Yeah.
One was that exit load window, which is too small, and second that overlapping width, because if you have 20 or 30 funds, then you
Yes.
have to rescale it to every time.
That's right. That's right. So the exit load is already on the list. So I'm pretty sure it should be done next month. This month, end of this month. And for the rescaling of the overlaps for too many funds, we are still kind of looking for how to kind of solve this issue, because obviously there's limited space on the screen. So
Can we remove that left side of this, or we can
yeah. That was one of the ideas, sir. We'll just kind of give a toggle button to just at least the left side goes, but sir, the height will still be restricted, no?
That is fine, sir. That is fine. See,
Yeah.
that
So
we can
yeah.
scroll down.
Yeah.
That we can scroll down. If it is on there, then we can scroll down.
Yeah.
But even that on the exit side, if you simply click onto this, it should pop. That is good enough. You need not to create extra space for that.
Yeah.
I simply, if I click onto this, if it pops up, that is fine even.
Okay. You mean pops up in a separate place or something, separate window?
Yeah, same place. Like, so that I can read it clearly.
Got it. Understand. Fair enough. Yeah, we can work on.
Thank you so much.
Thank you.
I have one doubt.
Yeah, please.
See, where you have called it as asset allocation, okay, in that pro.
Yeah.
But normally, normal meaning asset allocation is like asset allocation, even it's aggressive growth. You should have equity, debt, gold, these things.
Absolutely, sir. Absolutely. So here, I'll tell you, maybe we should update the name, but what we really mean when we say asset allocation is we've kept all the kind of main categories in equity, debt, hybrid available for picking, right? But the aggressive one is looking for a lot of return, so it tends to only pick up the equity funds. As you move to cautious growth, it is saying, I don't want that much return, I want more protection. So that algorithm is now, as you can see, choosing some debt funds, some hybrid funds. So what we mean by this asset allocation category in strategies is that we are leaving it open, right? You can pick equity, debt, hybrid, whatever you want, depending on your target. So for example, Prajakta, if you go back, I mean, we have medium growth. Just look at a quick view for medium growth. So we can add more asset allocation strategy. I mean, we've built this strategy section, ready for expansion. We hope that there will be 50 here, and then we will probably need to add a search box or some filters on the top so you can find the right strategies. And you can probably even filter with returns and vol and things like that on the top section. So yeah, I mean, the asset allocation strategy is supposed to be, an algorithm that's picking from all asset classes. So below that, when you see equity, obviously it'll be only equity mutual funds, and then there'll be debt mutual funds only, etc. So maybe we should change the name of asset allocation, or at least put some more text there to explain that.
Okay.
Yeah. Any other questions? Please let us know.
Anirudh bhai, one thing which I would like to ask, these strategies which you have prepared and the schemes below are based on the highest NGEN scores available?
Not primarily. They are one of the factors that goes in, but also, as you can, as will be obvious, is that depending on the category of strategy, the universe of funds available depends on the categories that we've made available. So the SEBI categories we made available. So for each of these strategies, there's a certain restricted list of SEBI categories that it is going to start choosing from. So NGEN fund score is one of the parameters that is used to cut off funds. In fact, what we can do is we can probably add an information section here, which clearly marks out what the algorithm really is, so that users are clear how these funds were selected. We'll do that, sir.
And for funds, we say 1 year old, and they will never come into this strategy.
No,
right?
sir. No, minimum 3. So before 3, so algorithmically speaking, we can't really put it in. Which is why I think when you pick up the template, you guys know that some fund has been launched a year ago and it's excellent and is doing really well. That's the time when you can take a copy and replace that. And you can still run the optimizer in the portfolio section and kind of re-optimize the weights anyway.
Because people, the new crowd investors
Yeah.
are crazy with the 10 rupee NAV, and so they are keen to participate in new NFOs.
Of course. So yeah, so then the best way to do that is, obviously take the template to the portfolio section and edit them, because obviously, as you can understand, we don't provide any kind of qualitative input at all. Everything is algorithmic from our side. So algorithmically speaking, we can't really judge funds that are that young.
Very true.
Yeah.
The thing is that.
Just
Okay,
one
thank
more
you.
doubt.
Yeah, please.
See, I have seen one fund which less returns. Okay, it's very subjective. Less returns. One fund which better, but with less return consistently has got highest engine score. Any reason?
We can definitely look into that, but the NGEN scores are usually always based on the particular categories. So it could be that that particular category generally has a low return.
So in the same category.
Right. So I mean, if you tell us the name, we can
For example, SBI multi-asset allocation fund and
let's load it.
UTI multi-asset fund.
Okay. Let's just load it. Also, this is an asset allocation fund, right? Okay.
Yeah.
Right. So this is the SBI fund is about coming second in its category, and UTI is about, and you can go to peers and see peer analysis. So sir, it's like can we sort on these rows, projector? One, yeah. See here, or just do like 3 years or something. So they seem to be doing okay. I mean, Quant is Quant and ICICI are on the top. Let's just look at the fund score again. Quant is there. So I mean, obviously we can check it, but just with a quick look, I think this is all right because I mean the returns are generally in range of the top in this particular SEBI category. And we haven't checked Sharpe ratios yet, but it's possible. So for example, here, yeah, Sharpe ratio. So your voice is breaking, sir.
So if you compare this UTI and SBI, just two funds, the comparison, UTI is better than still NGEN score is less. That is what he's saying.
I see. Let's just go back there to that next tab and just load the fund score again. SBI. Okay.
87.
Okay, so there is a slight difference. Now, okay, this we can check out. When the difference is not that much, it could be anything because remember the fund score is weighted on 1 year, 3 year, and 5 year. So it won't just be.
Just please go back to the return wala 1, 3, and 5, right?
Yeah.
Yes, see.
And also, so it's not 135 just return. It's also looking at 135 wall also. So UTI is the third line. And is what were we comparing? UTI and SBI, right? Yeah. So ऊपर ही है SBI. Yes, I mean we can dig into it further and check it. I don't think they're looking that different, but again the fund scores are also not that different from each other. So in a portfolio construction situation, these two will be very similar. That much difference in the fund score will not.
Maybe volatility is more.
The
That is
wall.
why.
Yeah.
Yes.
So UTI wall is around 11, touching 12.
Yeah.
However, SBI is just at 5.
Yeah.
5.25.
So even though it makes less,
becomes higher.
Yeah, even though it's making less, it's making less by costing much less.
Lesser return.
Yeah, costing much less.
One question.
Yeah.
In multi-asset allocations, every fund house has a different strategy. Some are doing onto debt taxation, some are doing onto equity taxations.
Right.
Some has a weightage to more to equity, some has weightage more to gold and all that. Some international components are there, and some have the strategies also that arbitrage strategy. That is why that their
differences will show.
Differences there.
Yeah.
So do you really track in identifying that the scoring also?
No, sir. No, we are tracking only the SEBI category. So we may have to look at this because we've already removed fund scores for things like ETFs, so very broad categories which have various different types of funds, because comparison isn't really possible in that case. Like it's very easy to score funds in large cap and small cap and mid cap, flexi cap, etc. And even the bond categories. But for categories like you're saying, if in this SEBI category funds are operating quite differently within the same category, then
yeah, absolutely, because there certain has international equity components, some has only debt, gold, and equity. Some are using 30% arbitrage into this. That is why their taxation keep on changing as per debt funds or as per that equity funds. 2 years or 1 years criteria is there.
Yeah, fair enough. I mean here, so the fund score is based purely on return and volatility, and a little bit of weightage on AUM. So
secondly, one question you said that you have removed weightage into ETFs, but there are smart beta products where you can actually give ranking to that.
That's right. So I mean, if they are not, if they're in a particular SEBI category, then what we have to do is we have to reclassify them, right? Because they're all in either kind of index funds or ETFs.
Yeah, there are pure ETF, which is simply passive funds. There are certain funds where they are using strategies like alpha strategies, momentum, and low wall that
That's
you
right.
can categorize in on a different fashion
Yeah.
and then do a scoring over there because
Yeah,
these are actually not a part of index.
Yeah, that will be the only way. So for that, we'll have to do a separate categorization exercise because right now, everything you see on NGEN is based on SEBI classification. So so we'll have to go through a separate exercise of reclassifying these funds.
Sure, sir. Thank you.
Thank you. Any other questions? Please let us know.
Please increase the number of questions in risk profiler at least to 10. Okay, this is a feedback.
Yes, sir. So we got this feedback. What we will do is we will basically give the user an option, right? So because as we said earlier, some users wanted a very short one because they want clients to finish it. But if you're okay with a long one, then we'll give you an option. You can send the long or the short, right?
Okay, done.
So that way. So give us some time. We'll work through some extra questions and so both options will be available.
Okay, thank you.
Thank you. Okay, if there's nothing else, Prajakta, you can close for today.
All right. Thank you everyone for joining in. You can definitely check out the webinar recording for this week's webinar by next week onto our YouTube channel. In addition to that, if you wish to subscribe to the pro version, you can do that by going on the settings tab on your NGEN Markets login. In the settings tab, under subscriptions and users, you'll get an option to click and which will say get pro. When you click on that, a pro rata pricing for the pro version will be visible right there. And accordingly, you could upgrade to use the pro version features. Thank you again for joining in. Have a great weekend.